Oil prices rise on an escalating conflict in Ukraine. US jobs and business confidence data is mixed. Australian housing affordability continues to worsen, and New Zealand's Treasury warns growth will be weaker than its forecast in May. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ commodity strategist Soni Kumari explains why ANZ Research thinks gold will continue to attract demand despite recent price drops.
We hold our bullish view on gold for medium and long term because I think investors' demand for gold will still be strong because easing monetary policy is still underway.
But first, in 5 and 5 with ANZ, global markets are mixed in late US trade after conflicting US economic data. Oil prices rose almost 1% after reports Russia fired an intercontinental ballistic missile into Ukraine, but without a nuclear warhead. US jobless claims were a bit lower than expected, indicating a resilient jobs market, but the Philly Fed's Manufacturing Business Confidence Survey was the third worst this year. ANZ head of G3 Economics Brian Martin sees the Fed maintaining its easing bias.
Although we do know that it is moving towards a more gradual pace of easing monetary restraint on the economy. Our view is that the FOMC is on the cusp of moving towards intermittent meeting cuts, so therefore not cutting at every meeting. And that largely reflects the fact that they are easing policy into a still strong economy. So they need to tread carefully in dialing back monetary restraint so as not to ignite a re-acceleration of inflation.
As of 4 a.m. Sydney Melbourne time, US Treasury yields were up a point or two, while the US dollar index was up 0.4%. The Aussie dollar was flat at 65.03 US cents, and the Kiwi dollar was down 0.36% at 58.54 US cents. Number 2, Australian housing affordability continued to worsen during the third quarter, according to ANZ's CoreLogic Housing Affordability Report. ANZ economist Maddie Dunk says it's the same trend for both homeowners and renters.
Housing affordability is declining, particularly in some of those smaller capital cities like Adelaide, Brisbane and Perth, which have seen really strong housing price growth over the last year. And I think at a broad level, if you think about how much incomes have gone up over the last year, we've seen incomes are up a bit less than 3%. Meanwhile, the median housing price in Australia is up 8.5% over this period. And for renters, rents are up 9.6% over the last year. So you are just seeing more signs that affordability is deteriorating.
Number 3, as the Reserve Bank of Australia grapples with when to cut rates, a key question is where measures of full employment sit. ANZ Head of Australian Economics Adam Boyton says last week's annual wage growth of 3.2% was slightly lower than average and provides a clue for how low an unemployment measure for full employment could be.
We have this soft wages growth. Now, at the same time, over the past year, the unemployment rate has averaged 4%. So that combination of the two would, everything else equal, lead you to the conclusion that full employment in Australia is possibly around 4%. The thing I'd say, though, is that wages respond to the labour market with a lag. So typically the unemployment rate will do something and then it'll take a couple of quarters before you see that reflected in wages growth. If we take those lags into account, then over the past year, you're looking at an unemployment rate having averaged closer to, say, 3.75%. So it's quite possible that the natural rate of unemployment or the full employment level of the unemployment rate is as low as 3.75%.
Number 4, Adam says that in Australia, estimates for full employment have been driving lower over time, particularly the past 20 years.
It's quite possible that the level of full employment in the economy is an unemployment rate lower than we have traditionally been used to. And I think that's really positive, particularly for those people entering the labour market or looking for a job. And it does tell us that potentially policymakers spent 50 years trying to solve the problem of unemployment. We might have, don't want to go too far here, but we might have actually, or they might have achieved that. That's a really impressive and extraordinary outcome.
Number 5, New Zealand's Treasury has warned growth is going to be weaker than it forecast in May's budget, with the current downturn deeper than expected. ANZ senior economist Miles Workman says while growth might be weaker in the near term, it might not stop Treasury forecasting a decent recovery in the second half of its 4-year horizon.
I am a little bit reluctant to take this speech as a sign that the bottom has completely fallen out of the Treasury's economic and fiscal forecasts. Because if you look at nominal GDP, well, that's what really matters for tax. That hasn't been weaker than the Treasury's forecasts up to this point, up until Q2 at least. And if you combine that with overall revenues coming in close to forecast, it's hard to look at that starting point and say that it's perhaps as dramatic as the speech might suggest. And further, if you look at the unemployment rate, that came in at 4.8% in Q3 this year. The Treasury were forecasting a 5.2% unemployment rate. So it's certainly not all one-way traffic. I mean, at face value, that lower unemployment rate may translate to lower benefit expenses. So how this filters through to the fiscal outlook, it's not clear that everything's going to go all the same way and that it might be as dire as perhaps the first read of this speech might suggest.
Miles Workman there. Now, for our bonus deep dive interview, ANZ commodity strategist Soni Kumari describes why the gold price dropped recently before geopolitical tensions saw it pipe up again, and why ANZ Research continues to be bullish on the precious metal.
A recent sell-off in gold was due to three reasons primarily. First, investors, they used to de-hedge their position after the US election, and they invest in risky assets. And that's why we saw gold prices falling and the S&P was rising. Further, the speculative position were too crowded, so the profit booking was overdue in our view. And the second reason for the sharp sell-off in gold was the strong rebound in the US dollar, which also reduced investors' appetite for gold. And the third reason was related to market pricing, a shallower rate cut than earlier expected, as macroeconomic data suggests a stronger than expected economy. And in case in the December meeting, if Fed skipped the rate cut, this is going to weigh on gold prices in the short term.
So why are you still bullish on gold in the longer term?
We hold our bullish view on gold for medium and long term because I think investors' demand for gold will still be strong because easing monetary policy is still underway, and that's going to support ETF flows, which is already turning positive from western part of the world. Second, the central bank purchases are likely to be strong given the tense geopolitical situation. De-dollarization is still underway, and there are factors who are suggesting the appeal for US assets is deteriorating. So these all factors will drive central bank purchases, and fiscal demand, we expect it's going to remain healthy. And in case if we are seeing any kind of fiscal demand losses, that will be compensated by investment demand for gold.
Now, with the election of Trump, there is some expectation that the United States' fiscal situation might worsen. What role might a worsening of the US fiscal situation play in the outlook for both the US dollar and the gold price?
Just to give you some perspective, US fiscal situation is already strained. So outstanding public debt of US is nearly $35 trillion and the debt to GDP ratio is nearly 130%. So in Trump presidency, debt is estimated nearly $7.8 trillion over 2025 to 2035. And that will push the debt to GDP ratios to further higher towards above 140%. So that is going to deteriorate the investment appeal for US debt. And in that case, investors will be trying to diversify their investment in the US and investing in gold. At the same time, central banks will also diversifying their reserves, investing in gold than US denominated assets.
How much of a role is physical demand from China playing in the gold outlook?
Fiscal demand from China has been quite strong this year, though we have seen recent deceleration in gold demand from China. But overall, year to date, if you see, the demand is still positive. And we think the recent deployment of stimulus package, I think it's going to boost consumer spending, and that will be supportive for gold demand in China.
Soni Kumari there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, November the 22nd. Catch you next week with what to expect from the Reserve Bank of New Zealand's cash rate decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.